Welcome back after a short break, and this is the part 2 of the AF3111 Intermediate Accounting 2 Week 4 topics on lessors accounting. Just before we have the break, we've defined what would be considered as a finance lease as well as operating lease. And then we talk about some of the indicators out of the 8 in order to classify the lease as a finance lease. And remember that you don't have to satisfy all 8 of them in order to classify the lease to be a finance lease for the lessor. Alright, in fact, as long as you can find the first one, which is the first indicator, the lease is a non-cancelable lease, and if you can find any one out of the remaining 7, then in fact you can conclude the lease as a finance lease. And of course, lessor has to classify the lease at the inception date, the date where usually the two-party, lessor and lessee, sign the contract. Okay, right, just before the break, we've looked at so far 5 out of 8 indicators, and we're going to move on and look at indicator number 6, 7, and 8. Okay, let's turn back to slide number 8 then. Okay, we are back to slide number 8, and we've just finished off indicator 1 to 5, and we're going to move on to number 6. Now, the number 6 one is usually a very difficult one to understand, but we rarely test it. Even in a professional exam, we haven't seen this kind of indicator being tested. Now, let me read it out. Any gain or loss from the fluctuation in the fair value of the residual fall to the lessee, e.g. in the form of a rent rebates that is equal to most of the sales proceeds at the end of the lease. Now, I'm sure just like everyone else, you understand every single word, but when they combined, basically meaningless to you, right? I bet. In fact, financial accounting these days, it would be a combination of accounting, law, tax, finance, okay? Combinations of different areas of knowledges. So these days, when you are looking at some of the accounting standards, you are like looking at the law book, okay? But how can we understand what that means then? Well, the best way to understand it is in fact by looking at the diagram here. Let's assuming that you have 6 years lease term. Unlike the residual value guarantee, which you've learned from week 3 RVG, and this time this is not RVG. In fact, this is a fixed payment that you must pay to the lessor. It does not depending on whether what would be the selling price of the lessor of that asset at the end of the lease term when the asset returned back to lessor and lessor sold it to a third party. It does not depending on that at all. But the lessee has to pay that fixed payment, right? And then once the lessor receives the fixed payment, right, and then manage to sell the asset to maybe to a third party, and the money that they receive is in fact, let's say, much lesser than the fixed payment that they receive from the lessee, then the lessor will refund the difference as a rent rebate back to the lessee. So that is what we meant by this indicator number 6. Different from RVG. Remember, RVG depending on the resale price of this asset. Okay, and then if there is a shortfall, lessee has to pay it to the lessor. But this is different. Lessee has to pay a fixed payment that was preset at the contract date within the contract. But then lessor would then, sell the assets. And if the resale price is actually, in fact, smaller than the fixed payment, then of course, lessor would return the difference as a rent rebate back to the lessor. Okay, that is the meaning of number 6. As I said, we rarely test it. In fact, we don't even have a single question in our tutorials. Okay, number 7. Number 7 is kind of common sense. The underlying asset is of a specialized nature that only the lessee can use it without major modifications. So what does it mean? It means that, in fact, that asset is quite unique, right? And unique to the lessee's business, all right? So let me give you an example. For instance, if a lessee would like to lease an asset, right, that was not even exist. So the lessee then contact a manufacturer, ask the manufacturer to produce this asset on behalf of the lessee based on lessee's provided specifications. So the manufacturer produced that machine. Instead of selling the machine to the lessee, it made a lease agreement with the lessee, right? And therefore the manufacturer become the lessor. Okay, so the lessee would use the asset for a certain period of time, right? Obviously, after lease term, right, the asset may be returned back to the lessor, which is the manufacturer. But then, if the manufacturer would like to lease this asset to another lessee, in fact, that lessee must spend a lot of money to modify that asset, because remember that asset was tailor-made for the initial lessee. So you can see that that is the reason, assuming that or having an implication that in fact the useful life of that asset is in fact nearly equal to the lease term of this asset. Okay, that is what that meant in terms of implication. Okay, so if it is so special that no one can use it except the current lessee, then that would imply that the lessee lease term would be more or less equal to the asset's useful life. Okay, so we've run through 7 of them. So far, you may be surprised that in fact we don't even have any calculations, right? Except, of course, when you compare lease term with the useful life, which is a simple calculation. But we're going to have a relatively more difficult calculation now. Indicator number 8. Number 8, where at the inception of the lease, remember, inception usually means the date of the contract between the two parties, lessor and lessee, the present value of all lease payments amounts to at least substantially all of the asset's fair value. Okay, so what they are doing now is they're comparing two figures, present value of all lease payments versus the fair value of that assets. Okay, if we can prove that the present value of all lease payment is substantially all of the fair value of asset, then we can say, okay, that is in fact what? This is in fact satisfying indicator number 8. All right. Okay. So why they were comparing these two numbers? Well, let's look at the diagram at the bottom. This is a kind of a simple technique helping you to understand why they compared these two numbers. And in fact, you've learned this technique from where? From management accounting. A decision making between to sell an asset, which is the fair value of the underlying asset, versus the present value of all the lease payments, which means to lease it. Okay, so you compare these two. It is a decision making, like for instance, when an asset will now belongs to the lessor, and lessor has to think about whether it wants to sell it or lease it. Okay, if the same price, or if the present value for all the lease payment is so close to the same price, then we can say that selling and lease it and sell it are no difference. Okay, that is why we were doing that comparisons. So let's look at the timeline at the bottom of this page. Let's assuming that the asset can be sold at T0 at fair value at that date 45K. But then if you lease it to a lessee, the lessee will have to pay you 10K first, together with another 10Ks over the 5 years. Okay, then what are you supposed to do then? Of course, you would then have to discounting all those cash flows, right? And then compare with the 45K. when you're discounting it, okay, all those cash flows, remember the first 10K at time t0 do not need to be discounted. You simply add it because that was the present value of its own, which is 10K at time t0. So you add them up. Now, you may notice that, right, I have highlighted the rest of the figures in red. Why? Remember, in week 3, we talked about them. They are considered as lease payments, right? And then that first 10K would not be considered as a lease payment because they were paid at time t0 at the commencement or inception date. So what I would like you to remember is when you have to applying the present value of all lease payment and compare with a fair value at inception date, which is time t0, remember you must add that 10K as well in your present value of lease payments. Okay, if you forgot to do that, then in fact you are not comparing like with like at time t0. Okay, so for classification point of view, for finance lease or operating lease, remember if there are payment to be made at time t0, you must include that in order to have a proper present value of those lease payments to compare with the fair value of the assets. All right. Okay. So notice that that's the point I made it here to draw attentions. Remember, all those lease payment, which means LP, would be including, or I should say, first of all, excluding the non-lease components, of course, and they are payments after commencement date, as well as payments at or before the commencement day, which including that 10K here. Okay, so now we know it. At the inception day, we compare PV of all these payments, including those payments that are made at the commencement date. That must be at least substantially all of the fair value of the underlying asset. So now the question is, what is the meaning of substantially all? Okay, substantially all in fact does not define within Hong Kong FR16 for the reason of, in fact, different users, different lessees would have different consumption pattern of using that asset. Same explanation that we have when we're looking at indicator number 3, remember, when we compare lease term with the useful life. But again, we need to have some guidelines, so we would borrow the US standard concept 90% as a benchmark for comparisons. So in short, if the present value of all the lease payments, that including payments even at time t0, and if they were either equal to 90% or bigger than 90% of the fair value, then in fact we can then claim that this indicator would be satisfied. And fair value, by definition, are simple. They were amount for which the asset could be exchanged or liability settled between knowledgeable and willing parties in an arm's length transaction. Usually means the market price of that asset at the time. Okay, let's go through that a little bit more. Remember, we've looked at the implicit interest rate calculation in week 3, and at that time I say we would not cover that too much because the detail will be shown in this week. And just like what we have talked about that in the previous slides, the problem now is, even though we know the lease payment, right, but which rate we should use to discount all those payments, how do we do that? Well, so we must know how to determine the implicit interest rate within the lease. And if you remember that back in week 3, we say the formula to work out that implicit interest rate would be the sum of the present values of the lease payments made by the lessee, including RVG provided by the lessee, residual value guarantee provided by the lessee, or I should say and RVG provided by a party related to lessees, or RVG provided by a third party unrelated to the lessor that is financially capable of discharging the obligations under the guarantee, including payments made at, before, and even after the commence date. From the point of view of the lessor, stop, be careful. I put that in highlight in red as well, bold and in red. It means that RVG, remember, for the calculations of to determine interest rate implicit in the lease, this RVG should be per contract, okay, per contract, rather than expect to pay basis. Expect to pay basis will be used by the lessee, right, to work out his lease liability. However, for lessor, when they want to determine the implicit interest rate, they use RVG provided by the lessee per contract. No need to subtract residual value to be determined by the lessee in the future. Okay? Plus, present value of unguaranteed residual value, which we've covered that last week as well in week 3. Those are the residual value covered by no one, okay, except that lessor believes it can receive it by selling the assets. That has to be equal to the fair value of that asset. Now, believe or not, you have just seen something similar in the previous slides. When I actually go through this illustration with you, I said, okay, if I now compare fair sales price of this asset at time t0 with all this lease payments, and if they are so close to each other, then in fact what? Then it would be considered as a finance lease. So we in fact can use the similar technology or method here, right? If we know the fair value, which is 45K, and then we have all the lease payment, and we also know the RVG and the URV, then in fact, right, we can then work out the implicit interest rate based on what? The internal rate of return method to work out that interest rate. And of course, no worry, because we would show you, we would give you that rate by ourselves within the question, so you don't have to be worried. You don't have to be worried, okay? The interest rate implicit in the lease will be, in fact, provided in the question, but make sure that you use that rate, okay, to, in fact, work out interest expenses. And as well as, if you want, you may have to work out other figures as well, such as the fair value of these assets. Okay, right, so let's move on then. Lease payment, what are they then? Are they similar to the one that we have from week 3? Yes, indeed, they are indeed very similar. So let me show you. They would including fixed payments, excluding all the non-lease components, right? So as usual, just like lessee, and they have to exclude lease incentive, minus it. Why? Because lease incentive, remember, is an incentive where lessor would like to attract the lessee to lease the assets, right? Therefore, this is a payment from the lessor point of view. Okay, so notice that the term we used in here is lease payments that are rising under the lease that are not received, including those that will be made at the commencement date, okay, when we will use it to calculate the PVLP at inception day only, okay? But for accounting entry, of course, the first payment at T0 should be ignored. But why we use lease payment, right? Because we're now talking about lessor, right? Technically, they are lease receipts. Why we use the term lease payments then? Well, because they want to simplify the kind of wording that they use in the standard. So when we talk about lease payment in the case of lessor, we know they are receipts. They're receipts, in fact. So fixed rental payment are in fact receipts, excluding non-lease component minus the lease incentive, plus any variable rental payment based on index rather than based on performance, right? Which we've covered that as well in week 3. And if there is any purchase option, then it is likely that lessee would exercise it. Then the exercise price should be included. So as termination options penalty may be included as well. Okay, and any RVG provided to the lessor by the lessee as per contract. As per contract. So that means you don't minus anything to work out expected to pay basis. They are per contract, full guarantee. Plus party related to lessee's RVG and third party unrelated to lessor RVG altogether will be lease payments. Okay, now so far we have looked at the 8 indicators, but before I show you a quick summary on how to use the indicators to conclude that in fact you have a finance lease or operating lease, maybe just to test your understanding about lease payments from the perspective of lessor and lessee. Okay, so you would have opportunity to recap what you have learned in week 3 in the following example. In this example, you have to determine the total lease payment of the lease to the lessor CMP Limited and the lessee AJS Limited. Be careful, we are not asking you to work out PVLP. No, this example is to work out the total lease payment without discounting. Okay, from the perspective of CMP and AJS. Okay. AJ Limited has a 5-year lease to rent an asset with an annual payment of 10,000. It makes a guarantee to the lessor CMP Limited. Stop. So it is likely that AJS is in fact the lessee, right? And CMP is lessor. That the asset shall have a value not less than 10,000. So this is the RVG per contract from AJS perspective. And AJS estimated that the asset would be worth 4,000 at the end of the lease. Okay, the parent company of AJS Limited is AJS Holding Limited, also makes a further guarantee 10,000. So they are guaranteed by related party of the lessee's AJS. And CMP in turn has an additional guarantee from an agent who has no relationship at all with CMP, and the value is 5,000. Okay, so now we know it. First paragraph tells us give us the information about the annual lease payment. And then the second paragraph tells us the RVG guaranteed by the lessee AJS. And then the third bullet point is the RVG guaranteed by the related party of the AJS. And finally, 5,000 RVG guaranteed by the independent third party. Okay, let's work out the total lease payment of the lease from the perspective of the lessor CMP Limited. CMP Limited should receive 50,000 of all the lease payment without the guarantee, so 10,000 times 5 years, 50, plus the guarantee that it guarantee that to the CMP Limited, the lessor. So the contracted amount 10,000 would be here, plus the RVG guaranteed by the related party of AJS, which is AJS Holding, 10,000, altogether 20,000. Remember, we also have the final RVG guaranteed by an independent third party, 5,000. So altogether, we have 75,000 for the total lease payment. That can be used to determine PVLP. Okay, but remember, those number here is the undiscounted total lease payment from the perspective of the lessor. Okay, now let's talk about lessee then. In the case of lessee is AJS. So from AJS point of view, total lease payment would then be 5 years, each year 10,000, so 50,000. But the RVG that lessees has to bear would be the contracted amount minus what the lessee believes the asset would be worth at the end of the lease, which is equal to 4,000. So at the end is 6,000 RVG expect to pay, right? So altogether 56,000. So you can see there, right? The two parties have different total lease payments. Okay, and obviously it is quite true that in fact lessor have more informations, or if you like, potential cash inflow from various parties under this contract. However, the lessees would only have to bear his own lease payments and RVG. So that is why the value are different. Okay, as I promised, I'm going to show you how to use the data indicator to classify the lease. Okay, so let's start with the first indicator. Can you find out in your lease contract that in fact the lease is a non-cancelable lease? If the answer is yes, then of course you have to consider further. However, if the answer is no, then it would be operating lease. Very simple. Okay, so if it is a non-cancelable lease, then if it is not a non-cancelable lease, then it would be considered as operating lease, as simple as that. Okay, or in fact, under that situations, if you have different views, like if in fact the lease is a non-cancelable lease, or it could be a cancelable one, but in fact it is under the 4 exceptional cases, then we would call them deemed non-cancelable lease. Then it is still satisfying the indicator number 1. Okay, just recap once again. If the lease is cancelable, but not because of the 4 restrictions or special cases, then you can simply classify the lease as operating lease straight away. But if it is a cancelable lease, sorry, I should say non-cancelable lease, but at the same time it can include deemed non-cancelable lease as well, and then first indicator satisfy, then you now have to look for 1 or more indicator out of the remaining 7. Okay, and if you can actually find 1 more, or more than 1 indicator out of the remaining 7, then in fact you can conclude the lease as a finance lease. In short, the minimum indicator you need to have or identify from a lease contract will be in fact 2 in order to classify the lease as finance lease. Okay, right, so if the lease itself is non-cancelable, and in fact you can find 1 or more indicator out of the remaining 7, you can then classify the lease as finance lease. What happens? Let's say you cannot find anyone out of the remaining 7 indicator from your contract. What would you do? Well, as per the standard, it says, can you verify within the agreement whether in substance that in fact substantially all the risks and rewards of that asset has been transferred to the lessee. So in other words, they are talking about any other things other than the indicator can provide evidence that in fact substantially all the risks and rewards has been transferred to the lessee. Can you find that? If you can, then of course it would be, you can classify your lease as finance lease. If not, then operating. Now in IA2, because we are not going to consider other situations or other indicators other than the 8 that we've talked about within the standards. So basically you can simply ignore this little box here, information within this box, and simply just consider if you cannot find any, you can find a non-cancelable lease indicator, but you cannot find out any one indicator out of the remaining 7, then in fact you can simply conclude that the lease is operating. Okay, so you make, in fact, what that means is you can get more marks from classifying the lease as an operating lease if the first indicator can be satisfied, because you may have to go through all the indicator and say no to them in order to classify the lease as operating lease. So it is likely that you can get more marks. However, for finance lease, you only need 2, and then you will be able to get the conclusion as a finance lease. Then you may in fact get less mark. Of course, if the lease is cancelable one, but not under the 4 situations, then you know it would be operating lease. Okay, let's then move on and see whether you understand how it works by looking at this questions, which is a classifications question. Classify the lease from the perspective of the lessor. Okay, X enter into a non-cancelable lease of a 5-year term with an equipment leasing company for a machine that has an expected economic life of 8 years. Okay, fine, fair enough. 8 years of the economic life, and the non-cancelable term is 5 years. Now, if we don't have secondary period, in fact, we can then compare lease term with the economic life, right? Or straight away. But before we make that conclusion, in fact, we should go through another point, okay, another bullet point before we move further. Okay, now, but since we've just look at the first bullet point, we know that the lease is non-cancelable, so why not just put that point into your answer, right? In fact, the lease is a non-cancelable one, so we satisfy the prerequisite indicator. And so what we need to do now is, if we can find out one more indicator out of the remaining 7, we can then classify the lease as what? Finance lease. Next, the second bullet point, we know that the lease is renewable for a further 3 years period at the commercial rates prevailing at the time of renewal. What that means is there is a secondary period, but then the rental would be subject to what would be that commercial rate at that time of a renewal. So based on the lessor point of view, lessor have to determine whether the lessee will lease this asset for the secondary period, 3 years. And the decision has to be made at time t0. So if we are going to give a commercial rates, okay, that would be based on the time of a renewal, then in fact that rate would not be beneficial or would not be a bargain rate. Then we can simply say that in fact the secondary period would not be in fact offering at a favorable rent. Then it is unlikely that the lessee will lease it. Okay, and so now we know that the lease term would not be 8 years, it would be just 5. So we can then simply compare lease term 5 with the economic life. Now notice that the answer I put it in here is lease term is not a major part of the asset economic life. So how come I do not put it as, like, if I take 5 over 8 is 62.5%, how come I don't say it is not bigger than 75%? But if you use the wording not bigger than 75%, in fact you are not applying the Hong Kong FRS 16, you are applying US GAAP instead. So it would be better that we use appropriate terminologies. So the way we do that is we put it as not a major part, and then if you want to show your working, put them in brackets. Only 5 over 8, which is 62.5%, and it is less than 75%. Therefore, this indicator will not be satisfied. Now that would be a more complete answer for that indicator. Okay, indicator number 7. The present value of lease term is equal to 70% of the fair value of the lease asset at the inception of the lease. Okay, and then number 4 bullet points, the last one, the manufacturer of the machine guarantee the residual value of the machines equal to 25% of the fair value of the assets if X, which means the lessee does not renew the asset, the lease, after the 5-year period. The manufacturer is unrelated to both the leasing company and of course, X. Okay, so remember, we are now classifying the lease only from the point of view of the lessor. from the lessee point of view, lessee doesn't have to classify the lease. Okay, lessee just use a single lease model. So now, obviously, bullet point 3 and 4, the focus is on indicator number 8. We compare PVLP with the fair value of the asset. We were told that there is a guarantee guaranteed by a manufacturer, which is of course a third party because it's unrelated to both the leasing company, the lessor, and the lessees. So therefore, it is clear that that 25% RVG guaranteed by independent third party should be part of the total LP, PVLP. So now we combine 70 with the 25%. At the inception day, PVLP is in fact substantially all of the asset's fair value, because to be substantially all we need is 90% or more. So in fact, that indicator is satisfied. So after going through all 4 indicators, some of the indicators may not be useful enough for you to make a conclusion, but we were clear that even if you list the indicator that are provided in the question but may not be really helping you to make a conclusion, you can still get marks on it. So at the end, based on indicator number 1 here, and the one which is the last one, number 4, we can then conclude that in fact the lease does transfer substantially all the risks and rewards incidental to the ownership of the machine to X, the lessee. Therefore, we can simply conclude that the lease is a finance lease. Okay, so that's how you structure your answer, right? We would test you on that. We would ask questions about lease classification, definitely. So you must learn how to do that. Okay, well, I think we've covered more than enough already within this 30 minutes or so. Maybe we take another break, okay? And after the break, you're going to like it because we're going to move on and look at accounting entry. Okay, let's take a short break again, and coming back, we have part 3 of lessor accounting. See you later.